Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest updates. Well, the U.S. economy is at a pivotal moment. The unemployment rate has climbed to 4.3%, and while the GDP grew at an impressive 2.8% annual rate in the second quarter of 2024, the specter of a potential recession looms large. Now, consumer spending is robust, although we're starting to see some cracks, mixed signals that are keeping economists and policymakers on their toes, to say the least. Now, today we welcome back a special guest to the show. Claudia Sahm is the founder of Sahm Consulting, a former Federal Reserve economist, and she's now the chief economist at New Century Advisors. She's also the brains behind the Sahm Rule, a key early recession indicator that we've been hearing a lot in the news lately. Claudia, welcome back to Kitco.
Great. Thank you for having me.
Okay, we got a lot to get into. You just published a new op-ed on Bloomberg about the Sahm Rule, and we've been seeing it in the headlines, and even Powell himself talked about the Sahm Rule at his latest press conference. For those that don't know what the indicator is, start a little bit about explaining what the Sahm Rule is and why it's been getting so much attention lately.
So the purpose of the Sahm Rule was to be an indicator of the early stages of a recession. So not a forecast, but we're here, right? And it focuses with the specific intent of then being able to inform policymakers. You know, in a recession, there are different things, whether it's the Fed or Congress that takes action. So the idea is to identify early recession. The way the Sahm Rule does that is it looks at the unemployment rate. And it is a regularity that as you move into recessions in the United States, you go from what sometimes are relatively small increase in unemployment rate turn into large ones that they feed off of themselves. And the Sahm Rule, there's a formula, take 3-month averages. You look over, now to the prior year, a half a percentage point is the trigger. I mean, it's got to have the details because it is, have this rule of thumb. And yet it's capturing a dynamic that you could, write down in different ways. But unemployment rate rising, generally, not always, but generally is bad news, and it can get worse.
Mm-hmm. Okay, well, we had you on in February. We were lucky enough to book you. And let's take a look back at that clip from February, because you stressed the urgent need for the Fed to cut rates to stave off an early recession.
Right. On the data that we have in hand, one could make the argument they should have already cut. Right. Again, I'm not asking for 200 basis points, 2 percentage points at one meeting. It's this, we want to do it gradually, a quarter percentage point, every meeting, maybe every other meeting, just kind of see how it goes. One thing the Fed has also said, I don't think this definitely comes out at the press conference and some of their more like market audience discussions. They see it as a huge mistake if they start cutting and then they have to raise, like if inflation would come back. So that's why they want to be so sure. And yet, the world hits us with things and you adjust. Right. To me, the worst possible outcome is not they cut and have to raise. The worst possible outcome is we have an unnecessary recession.
Yeah, isn't that the case? Okay, you said it right. You said it well as well. The Sahm Rule has been triggered, indicating a potential recession. However, in your recent op-ed with Bloomberg, you mentioned that although the rule suggests a potential recessions, you don't really think that we're there yet. So explain to me why the indicator says recession, but you believe it's not the case.
Right. So my read of the economy, big picture, not just looking at the unemployment rate, which is all the Sahm Rule kind of takes into its metric, but looking at consumer spending and income and production and job gain, like really looking broadly at what's happening in the economy, which has been so important, particularly in the last 4.5 years. Things have been often very confusing and patterns have broken down. If I look big picture, the U.S. economy is continuing to expand. Right, you have to have a broad-based contraction for it to be a recession. Right, it has to, and that does not appear in the data we have. Now, unfortunately, when things start turning, the data tend to sometimes over many years revise. So we may not have a full picture of where things are. So I can't say with complete certainty that we won't later look back on this and say this is, in July of 2024 we're in a recession. But across the indicators, that is not my read of it, and yet. Right. The goal here is not just to avoid a recession in July of 2024, is to avoid one in this month, next month, many months to come. And so the fact that the unemployment rate has been rising, and if you look at these other broad set of indicators, we do see in the economy, even if you wouldn't say contraction, you would say a slowing. Now, the Federal Reserve likes to use the term normalization. They're big on the euphemisms, right? That we were, going too strong, we had to normalize. I'm totally with them on that. But once you're at normal, and Jay Powell last Wednesday, 2 days before Jobs Day, said we don't want to see any more weakness, right? We're back to normal, right? Things should stabilize. And what we haven't seen right now is that stabilization. And really on Friday with the employment report for July, it's suggesting things might be even getting worse at a more pace, and that we'll find out if that's really the case. It could be that was oversold some, but we've had months and months of things slowing, and we still have interest rates that are high. It's like, what do you expect? You're putting downward pressure on the economy. Which direction is the economy going to go?
Yeah, well,
Right,
you
like that
mentioned it.
shouldn't.
I mean, the key is timing here, right? I mean, if the Sahm Rule has been historically accurate, why should we discount its signals now? I mean, is there more specifics that we can get into other than just the general data we're seeing now?
Right, I think it's one of those. So, are we in a broad-based contraction? Probably not. Likely not. And that is at odds with the Sahm Rule, because that was its whole point, was its purpose in life was supposed to be turn on early in a recession. It didn't do that. It appears. And yet that it is sending a warning signal about the direction of travel is not good. And so we have it's just because it isn't it's overstating, I think, and some people disagree with me. That's fine. It's hard to read these data to really know, are we really that close to the edge of a recession, or are we a good bit away from it? I don't think we're in a recession. I don't think we're right on the precipice. I think we're getting way too close for comfort, and frankly, it's again, the lever of policy that is most likely to be pulled right now is reducing the federal funds rate, the Fed stepping in. It's unlikely we have fiscal policy as a support, and that lever generally takes some time to work. So time is of the essence right now.
Mm-hmm. And you mentioned we're getting close. I mean, you've pointed out that the rise in unemployment might be due to increased labor force participation, particularly from immigration. I mean, how does this factor make the current situation different than the previous recessions we saw?
So we have certainly had times, if you go back into the 1970s, where the U.S. labor force was growing and we still had recessions, right? So just because we've had a labor force increase, and it is true that when people come in or come back into the labor force and start looking for jobs, it can take them some time to find a job. And in particular, with, say, immigration, there was a big change. And we had labor shortages that were also pushing down the unemployment rate, complicate the Sahm Rule some, pushing down the unemployment rate, and then we swing from some, bursts of immigration, and certain parts of the country, maybe there's more immigrants coming at one time, and so that can address labor shortages. That's very good. It also creates some adjustment issues. And an adjustment issue shows up in unemployment being a little bit higher. As long as those jobs catch up, then unemployment kind of comes back down. And it's not a cycle that feeds on itself. It's very hard to get a sense of how much of this is happening. It's not even just that the labor force is increasing, you're having different groups, it's the abruptness. It just time. We've had a lot of very abrupt supply disruptions the last 4.5 years. This one happens to be in the labor market.
Yeah. I mean, could it be that we're underestimating the impact of weakening labor demand? I mean, how do we separate the noise from the signal here?
Yes, it's very hard. So what I have been trying to do, and others more broadly have been looking as well, is okay, well, the Sahm Rule, it's a number, 0.5 percentage point, the increase. And it's like, okay, well, what's usually happening in the US labor market under the hood? What's happening that gets us to 0.5 percentage point? One thing that I have been doing is looking at the different reasons for unemployment. So if you're a new entrant to the labor market, you've never worked before, or you're coming back, or you've been laid off temporarily, permanently, and just looking at, okay, what are those changes in the composition of the unemployed that get us across the goalpost of the Sahm Rule triggering? And then looking at different uh, in different recessions, and frankly, it can be quite a mixed bag. It is unusual right now. There's more contribution, like the increase in the unemployment rate. There's a bigger contribution coming from these entrants, so into the labor force, than we've seen in recent recessions. But again, you go back to the 70s, and that was the case. So when I look at the components of what's driving, or like who are the unemployed that we're seeing, then I see it definitely raised some just kind of concerns with my approach, because I think there really is some of this supply in there that wouldn't necessarily be a recession. You don't want to have a false signal. And yet there you do have to also kind of think about, well, what are employers doing? And we know from other surveys that the rate of hiring has fallen back quite a bit as we've moved out of these labor shortages, kind of to like where they were in 2014, which the unemployment rate was quite a bit higher. It was not a good recovery labor market. And so if you're looking for a job, like employers really just aren't hiring in the same extent, whereas they aren't laying off. So you can be like, well, then that's another reason that could be a very, if companies haven't been burned by the the labor shortages, laying off a bunch of people, having trouble hiring them back, now they're maybe hoarding the labor. Like they're being very cautious about laying off. And so then the margin, they're like, well, we don't have as much demand, so we just won't hire as much. So you have to be very careful. Like these are complicated patterns. So I see a lot of weakening labor demand. And again, we were running probably at an unsustainable demand because the shortages and like the economy was really cranking. We did have the higher inflation. And yet it's not shown signs of leveling out.
Yeah,
And that's
it's
a
interesting.
problem. And then it's like, again, we have a policy lever that has not been pulled in terms of taking downward pressure off. Like what do you expect? It'll
Yeah.
keep weakening.
I mean, Intel, there's been quite a few of the big Mag 7, some of these tech companies that are doing some layoffs. But, when is this going to hit the consumer? I mean, I saw less people are going to be going to Disney World this year. I mean, that's the projections and what's been happening. Expedia bookings are down. We keep hearing that the U.S. Consumers holding up the economy, but we keep seeing these cracks, not to mention the credit card debt. I mean, are we in a tougher spot than we currently are talking about?
So we are, it's hard to say, right? Like the anecdotes, and especially you mentioned the layoffs. We had, sadly, for almost 2 years, we were on recession watch in the United States constantly. In 2022, most of 2023, we had 2 quarters of GDP declines, which is the most famous recession indicator, right? And we had that, and there was no recession. You got to go back to 1947 to find that. So again, we've broken a lot of our rules, and there was a lot of discussion, particularly as you went further into that, where the tech industry, and there were lots of layoffs. And you could see that in the California data, and you could see it with industry, but it also had this very specific, there was a lot of hiring during the pandemic, and then they're normalizing off of that, and then it's just an industry, so it didn't spread. Like those jobs lost were real jobs that were lost. That was a real dislocation. You could see it in the regional economy as well, and yet it didn't become a U.S. recession. And so it's always tricky with the industry, and the anecdotes is, do they start spreading? Consumer spending growth overall has slowed down, income growth has slowed. It's not that things are contracting, but they are slowing. And that's fine as long as we settle in, but it's the direction that's worrisome. And I'm much more concerned. I still don't have a baseline for a recession in the coming months. I haven't had this whole cycle, but these are conditions much closer. Like the recession risks are elevated for kind of a broad-based weakness.
Yeah, and it seems as though, I mean, the data comes ridiculously fast, and it can really catch up to the Fed Chairman Jerome Powell. I mean, he was talking about 50 basis points being off the table in September. Maybe with these latest revisions, that's being rethought.
Yeah, life comes at you fast. Yeah. So the Fed they are a data-driven institution. I think, frankly, they've been more kind of hyper data-driven. And it's like, we're not going to, we want more inflation data, right? You can take it too far, and yet they're going to very carefully assess, and they know anyone who works in the space of kind of tracking the economy and thinking about downturns knows that things will start moving fast. And so I started my career as a forecaster at the Fed in 2008. That was when I learned how to forecast, was during the recession, the slow recovery. So you have to have a story, and it's important for the Fed to articulate their thinking and how they're reading the data. And then if the data come in, and they will put have some really, well, they have healthy skepticism of the Sahm Rule as just a pattern, but they'll have also, is that labor market data, is that going to really persist? Is that they're going to want to and should, try to understand and definitely not overreact. And yet the Fed, they know this drill, right? There are times where they have to, they must, and they do shift. It's always nice to get ahead of things, but that's often not how it goes.
It's a hypothetical question, but when we last spoke in February, you emphasized the need for rate cuts. You said that the Fed should have done so in March. Do you think that if the Fed would have cut a rate by then, maybe we'd be in a better position today?
I don't know. I think waiting as long as they have, because we won't ever know. I could say yes, of course I would be right. We didn't get to see that world, so I think there were good reasons. And even after we talked in February, the inflation data continued to disappoint. Right, the forecast of where it was headed, what I had, this is where we are now. So I feel good about that, and yet I can understand why they felt the need to kind of slow it down a little bit in terms of getting going with cuts. It was a real missed opportunity last week to, they could have cut in July. It looked so like they had the crystal ball to do that last Wednesday, but they didn't. It's a missed opportunity. It's not their last opportunity, and they will get. I think they'll have potentially some catch up to do, which isn't the best way to do it. But they need to get going. I am worried about that. Right? It does. The lags are real. Yeah, because it takes time for the relief to get there, and I don't expect a lot of support coming from other parts. Right? I wouldn't expect fiscal relief or Congress. I think Fed's kind of like, if we're going to level this out and get us, they're the game in town, and I think it's still, but I don't know that, and frankly, I think it underscores it was time to start letting off the brakes a little.
All right, Claudia, even if, the labor force participation is a factor, isn't a rising unemployment rate still a warning sign? How do we ensure that we don't miss the early signals of a recession like we maybe did before?
Right. The rise in unemployment absolutely is a concern. Not all of this is labor force participation. Not all of this is the kind of good kind of unemployment. And we have seen the unemployment rate move up multiple months in a row, right? This is not a one-off. So we have, and it's the momentum that we have to, really guard against. So absolutely good news, likely not in a recession at the moment. If the Sahm Rule has failed and yet turned attention to a real problem that is brewing and helps us avoid the recession, great, right? Like, we should be having a conversation about what's happening in the labor market.
Yeah. But you're worried about how close we are in entering that possible recession, yeah?
Yeah, well, it's not even just about the recession, right? A labor market that is firing on all cylinders is good for workers, and it's good for growth, it's good for productivity. So I get it, things needed to slow down to some extent, get back to normal. It's the idea of, don't slow it down more than necessary. Again, inflation, we got inflation. We can have low inflation and high growth. Like, these two things do not have to contradict. Or if you have a productive, you've got, a lot of, the investment, the workers have the background, they're matched up in the right kind of jobs. So we should be keeping this as good as it can stay. And so really any weakening at this point is weakening we should be concerned about and trying to back away from.
Yeah. It almost seems like it's all about timing. I mean, you've been repeatedly, criticizing the Fed's slow response here, arguing that it could lead to what we're talking about now. But, as we continue to look at this caution stance and obviously the data that comes at us, like, what would you be doing to change this fundamentally if you were running the show there? How do we avoid this?
The Fed has pointed in the right direction. They've already said they are in place. They're going to start reducing interest rates, right? And I think, and the markets clearly think that that's where the Fed is headed. And I think the Fed will take a cue from markets and be pretty, really get at it. And that's what we needed, right? It took longer, I think, than it should have to get to this point, and yet we have an economy that is in a really good place. It needs some pressure taken off it. And the Fed is aware of this. They have been, and I take them fully at their word. They understand and really appreciate the dual mandate. So not just the inflation and price stability, which is very important, but also the maximum employment, keeping the jobs. And they're at a stage, and they've said that very clearly, that they're going to balance those two. And unfortunately, the labor market, I mean, they need it. They need a little bit of help. So
I mean, they've been talking about cutting rates. If they did it too early, we talked about Arthur Burns last time, you and I. I mean, if there's larger inflation that could come if they cut too early. But I mean, how do we avoid backtracking on the progress we've made? Or is it just time? I mean, are you in the camp like, let's get this thing cut? This isn't an emergency meeting by any means, but we need to follow up with a larger cut?
Yeah, I don't think we're in an emergency place given what we know right now.
Yeah.
The weaker position you're in, the more chances you are to show up in an emergency, right? Like, we don't have that, but you might get more vulnerable to it. But no, it's just a matter of now it's time to ease up some. And I think, I understand we want to see more data. We want to be certain that we've done enough on inflation. I get it. I appreciate that. And yet that just, now it's clear with the data on the labor market, you don't have that luxury of time anymore. And so you switch gears. So it's more of a shift and to get going. But I don't see it as all is lost. And frankly, it's like, this is where we're at right now. So you do policy going forward. You can't go back and redo where, the last meetings.
Yeah. And we keep looking for signals. I mean, lastly, with the upcoming Jackson Hole Symposium, obviously it's going to be closely watched, especially Jerome Powell's remarks. What signals should we be looking out for here? And, how critical is this moment for the Fed?
This is a critical moment, and it got more critical last week.
Yeah.
It's complicated. They have to, because it's not just about we're going to start cutting, and everyone want to know, does that sound like they're going to do 25 or 50 basis points in September? I mean, set all that aside. It's just we're moving into a new phase of, now it's the Fed's term to normalize, right? Like, they've got the economy, the inflation come down, the unemployment's drifted up a little. Now it's time for the Fed to get out of the game. But that's a new phase. So at Jackson Hole, Powell should be opening up that chapter and giving us a sense of how the Fed's thinking about it. And it may not be all that different. It may still be we're data driven. We're going to look, but that's the kind of, like, how is the Fed thinking about setting itself up and positioning for this next phase? Because we spent a lot of time on, is it time for them to get going? But then it's going to be a question of, well, when have they done enough, and how do they
Right.
calibrate it? So,
Any specific indicators there, Claudia? I mean, what would you consider a successful outcome from Powell's speech?
oh goodness, the extent, some clarity
Yeah.
in their thinking. A lot of what the Fed does, a lot of what Powell does in terms of the public speaking, is making sure, it's not confidence in the sense the Fed always gets it right, but that they have a thoughtful approach. They're grounded. I think Powell has met the moment in his time as chair. We've gone through a lot, from the pandemic, the Fed raising rates, high inflation, to now, and he does. He's a really good voice for the Fed, and that may sound a little silly, but through times that are difficult, you need to have leaders who are in place that instill confidence, deserve confidence, they do, and have a plan. So I think I think Powell will continue to push this along. This is really tough. And one thing that, it's this will be a really tough one because it's not just instilling confidence and do we have clarity, how are we thinking about this. We could go into Jackson Hole with financial markets being more ill at ease.
Yeah.
Right. And that is where the Fed is talking, and you can have, the Fed never wants to inject panic or uncertainty. And yet in very uncertain times, it can be really tough to check all the boxes and have everyone walk away feeling like, oh yeah, we're going to be okay.
Right. How difficult is that? I mean, we saw the sell-off last week. We saw that there was job numbers that didn't come into expectations. People kind of panicked. There was a lot of selling. Then buyers came back into the market. And as we see today, we don't know if this is a continuation of a market sell-off or if this is just the new normal. I mean, everyone is watching what the Fed does here.
Right. So it's super complicated what's happened in markets in the last week. And it's not just in the United States, right? So we had a lot with the jobs report and the Feds, and, there were just a lot of disruption and uncertainty in the US, and then you have in Japanese markets, and there's a lot of interconnectedness in financial markets that things can happen that don't necessarily no one person can tell the story. So there's definitely more uncertainty. It looks like things have there's more green on the screen again, so things have calmed down, and yet we're going to need to see more of the data on the economy. Like next week, we're going to get the inflation data. That does not have to be a good day, right? The Fed has told us they want good inflation prints. We could, it doesn't have to be a good print. So I think there's just going to be a lot of. I think it's going to be good, but we have a landscape that is pretty tricky, particularly when markets are trying to figure out, like, is the Fed really going to do 50, 25, right? And knowing the Fed it'll depend on data, but it's data we don't have right now. And the data, even when we have the data, they have been very confusing recently.
Mm-hmm. Yeah. And then revised again. All right. Claudia Sahm, economist and principal at Sahm Consulting, former economist at the Fed. Hey, thank you for this, Claudia. I know it's been a crazy day for you. We appreciate you making the time for Kitco.
Great. Thank you.
Thanks so much. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. We've got some great content coming up your way. Don't forget to hit that notification button and stay in the loop. We'll see you next time.